Thank you very much for inviting me as your last speaker. I know always that's a very grateful task. Everybody's falling asleep. Let me quickly say something to Baron's speech. I thought that was a pretty well characterization of what actually it needs for a founder to become successful. Still, it's very complex, and the takeaways are always a bit of confusing. Let me just quickly know, who's actually founder in this room? Just quickly point up, who of those founders have been to one financing round so far? So we actually have some live examples over here. Any investors also? So a bit, 1, 2, 3, Ada, 4.5. So okay, so it's a bit of a founding mix. What I will do today, and let me see how that works. I give you a very short answer of something which I think nobody really can answer. Is there a standard to assess founders of the view of a banker, like myself, on the other side, as an investor? The answer is very simple, and I'll be very disappointing for you. I think you can't. It's just impossible. However, we've been asked by one of the venture capitalists in Europe whether we can set up kind of a research facility, whether we can measure an objective scoring, accounting, whatever system, and test this over a lifetime of the fund. So we started that 2 years ago, and it basically, what you see over here, it's a typical financial analysis when you run through one of the grill sessions with Hummingbird about your KPIs, evaluation, financial projections, and so on and so forth. So objective valuation, objective risk assessment. The other part, how's the technology? How are the products? How's the implementation, execution, one of the biggest issues? Organization, and team, people. So those were actually the tricky part where all the investors basically said, listen, this is something where we need to put some objective on this. And I only give you one page, not to bore the hell out of you, and you see this over here. So basically what we've done, we've taken subcategories. For example, on the first one, technology, and it probably bumps up over there, and have taken a scoring system where we discount the valuation, whatever that means, of the company. And what we will do, we do this for every category, people, organization, technology, product, and so on and so forth, and test whether our assessment objectively will match the success of the fund afterwards. So basically, Ada, what you need to do, you need to invite me again in 10 years, and I will let you know whether it works or not. So basically, there's no really an answer to standards. So therefore, let me go to the question Ada was asking me. Can I give you some insight over my last 20 years where I have followed a bunch of technology companies to their A, B, C financing round, their exits, their extraordinary fundraising because they were running out of cash unexpectedly, and so on and so forth. And let me start like this. The do for the founders. And please challenge me in between if you want, if you think that's completely bullocks. But that's my personal experience. Don't take a claim for completeness or anything else. Know your business. It pretty much covers Baron's point about passion for detail. You have to know pretty much any brick and mortar of your business, any number. And that also applies if you're sitting together with your tech guy, or CTO, CFO, and you are the CEO, it doesn't really matter whether the CEO can, the CTO can answer all the tech questions. You have to do this also as a CEO and CFO. You have to be universalist in the beginning and in the founding time. Really know anything immediately. It's probably one of the key successes in any of those fundraising events which I've done, that people are prepared, that they're well informed, and that they live their company, any brick and mortar. I'll give you an example. Mama Shelter, does anybody know? Triggener, it's Club Med, the founder of Club Med. I've seen it once. I mean, if everybody has seen it or will be anywhere on a panel, please listen to him. This is the guy, he's a maniac. He knows his code, he knows his financials, he knows the business model, he knows pretty much everything a company can know. The guy is mid-aged. You would never expect it. He's French. They don't seem to be talented for detail. Sorry if any French are over here. So It's very intense. Same applies for Michael Halper, who now is a board member of Nokia, who sold his company Gate 5, which is a location-based company, to Nokia 4 years ago, entered the board, and now when you have a Nokia phone, not a lot of people have it anymore, there's a navigation system in there. It's Gate 5. These were examples of probably obsessive knowledge of the company, and they were very successful. Made a lot of money, created incredible business models. So I think it's worth keeping up. Know your market. I know I'm boring you with that, but it is like it is. If you don't know your competitors and your numbers of your competitors, how they're positioned, how they're performing, what does their management team look like, you have a real issue. And you will have an issue of fundraising, but funnily enough, also whether you will be successful or not, that's very questionable. I'll give you one example. You know the billboard company, JC.Deco. There is the sister company here in Istanbul. It's called Ströer or Wall. You know, the bus stops and all the advertising stuff. Jean-François Decaux runs a stock-quoted company, third generation, so it's not really a founder, but he's a founding family. He goes to roadshows, to banks which do not cover his stock, but his competitors, and challenge, in all the discussions with the analyst, challenge the analyst in terms of his market intelligence, in terms of his knowledge about his customers. And the reason for why he's doing this, because he wants to know what other people have gathered about their competitors. He really spends time on the road of a 6 billion euro company to understand how are competitors positioned. How does third persons, like an analyst, how do they feel this person? How do they consider the strategy? How do they consider their designs, and particularly for outdoor advertising? So it's pretty impressive, I have to say. Balanced team. I think we heard the word team in most of the presentation today over here. The people, this is probably the most crucial factor of founders. As a fundraising agent or as an investment banker alongside with our clients, basically we've seen a functioning team always is very helpful. Secondly, we believe that the key disciplines need to be covered and under control, and we need to have an elimination somehow of the shortcomings. You know, and there's always somewhere in the founder setup, there's one missing link. Either it's the tech people, it's the CFO, which we just heard. There's not real CEO, but is a great founder with a good vision. So there's always a shortcoming. Try to eliminate that as early as possible. And if you don't, communicate it openly. But you will see that on my next pages. Let me come to the last point, your investor. I've seen a lot of founders in presentations who knew a flying fuck about their investors. They were not prepared, they didn't read what they were doing, they didn't know what sports they were doing, they didn't know who they knew, they didn't check in all the social media websites and who they've been linked to. Anything which is pretty transparent, particularly in your industry, is so transparent who you're talking to. And I find that incredibly, let me put it, stupid. And my best example for that is, you know, if you look for your spouse, or basically if you are in your life cycle for looking for a partner of your life, you will do that all very naturally. Yeah? You will be interested in that. You will do your due diligence. I know it sounds very strange, but take it as an example. It may help you a lot. In terms of and more do's, let me give you 4 points which I believe have been the key do's which I learned over the last 20 years, which I personally find, if you apply them, make a hell of a lot of sense and an improvement to your business, and particularly in fundraising. Ambitious and doable business plan. You know, it needs to be factual, it needs to be bankable, it needs to have a clear diction if you write a business plan. Don't get flowery words in there. Don't overdo it with adjectives. Super or unique, superior, or whatever that is. It's really, it's not helping. Secondly, see that you have a red line in what you're saying. And I can only give you a good example over there. There's a guy called Vern Harnish, Mastering the Rockefeller Habits. It's really worth a read. And it's basically, you see this third bullet point over there, B-hack, the big, hairy, audacious goal. So this is basically how you start your business, and that's as far as I understood Baron. You look at the horizon of your entrepreneurial life and say, this is what I'd like to achieve at the end of this venture. You know, the goal at the end of the horizon. The second one is, look, what are the values which I put into my company? What's important? You know, how do I want to run this? It also implies a lot for your team you will choose afterwards. Thirdly, annual goals. And then you see, I'm breaking this down to your 30 days goal. And it's all consistent. It's all consistent with your big, hairy, audacious goal. And if you put this in your business plan, it sounds doable, even if you have an incredibly vision. You know, like, put it like this. What could be a big, hairy, audacious goal? It could be replacing Facebook and mobile. That's a big goal. So then you have to break it down to make it actually believable, doable. And you can do this, first of all, by listening to me, and second of all, read this book. It's really, really helpful for also clarifying to structuring your mind when you're going into fundraising. Alignment of interest. That's a tricky one. Probably most investors will look for a full alignment of interest. Simply said, they will look for entrepreneurs who will find it very difficult if they fail afterwards to stand up, that they really have to put their finger into the heat, that they feel the heat, that they are not overpaid and run and jump as high as possible. So if you think about, or if you just put on your glasses of an investor and say, how can I align my interests with him? Put yourself in the same shoes as you putting your own money into that business. It will help you, and it will help your business plan a lot, because that's basically where you start talking on the same height, which you would like to achieve. King versus rich, just wanted to point out this. This is something I've met a lot of, and I cannot tell you what's good or bad, but I've seen a lot of entrepreneurs who always wanted to be the king. It's my company, maximum of shares, and I've also seen investors who said, I'm interested to partner, I'm interested to create an overall higher value of the company every year by even diluting myself. You've seen examples like Microsoft that worked out pretty well on the rich idea, but you also have seen king examples, take Facebook or others. So you have to really figure out which side you are, but design also your team, and also inform your investors about this, where you see this. Certainly the king guys may have some issues with investors at a later stage. Appearance and communication. I don't want to bore you with that, but at the end of the day, I still believe, you know, if you're business casual with your investors, even no matter what industry you're in, where you feel comfortable in a private yet professional way, you're always doing great. But don't forget one thing. It's all about trust. It's all about building up trust with your investor. He needs to, you know, he puts money on your head, he puts money into your life, and money has basically a character. You know, when you're scared of once, it's like a deer. When you shot right next to it, it will never show up again. So that's probably one of the key takeaways I have. You know, building up trust and so on. Points like, which I've given over here, whenever somebody wants this presentation, let me know, I'll send it over. The time factor, I think there's a rule of thumb. You always need twice as much time as you anticipated. And that actually works out for every fundraising which you think of. It's highly important because it also has an implication on the amount of money you're looking for, because you need another 3 to 6 months longer than you expected. So always over-fundraise, because you will need longer time. And the market has changed a little bit. I think Turkey is still very, very strong. Last year, it has been an amazing VC market, also in Europe. In Europe, it's cooling off. The time we see this, minimum time to fundraise 10 million to a Series B or whatever you want to call this, will probably take 6 months at least. And I would be surprised, I've seen some in fundraising, if you would say, we've done it below 3 months. If somebody's over here, I'd love to talk to him afterwards. Oh, maybe. Okay, here for me, I was asked in one keynote speech in London, what are the don'ts actually which can you write down for founders when you were talking, when you were in walking with them to roadshows, when you were seeing investors, when you were just listening on the other side or on their side. And basically, let me categorize this in 4. Management, I think one of the biggest disasters which I've seen with management is their heterogeneous voices, contradicting management. One is correcting the other one. I think this is basically, it breaks apart any discussions from the beginning. And you may smile now and saying that doesn't really happen. It happens very often, unfortunately. Train this with your team. Test yourself when a conflict arises and you don't believe anymore what your colleague is saying during a presentation. Find a conflict resolution for that beforehand, before you go into war, into a situation of a presentation. Management presentation ends with the last page. Well, that's probably also not true. It always lands with signing and closing. We've seen a lot of people and a lot of founders who have put a lot of effort into the management presentation. Don't forget, the hard work comes afterwards, after you have met your potential VC or investor. That's where the work begins. That's where the nitty-gritty part, the evaluation, where they will test your psyche, your personal way of executing this transaction. Highly important. Don't think you've done a great job. Keep up all the motivation in your life getting this done. Last but not least, promotional flowery diction. I told you before. We've seen a lot of business plans who sound more like action movies. You know, they're very colorful. This is not what you want to do with people who spend money on you. On the investor side, what are the real don'ts which I figured out? I always find cold calling from founders always a tricky one. I can tell you probably 50 European investors who actually don't take cold callings anymore or cold writings. They only go by reference. So if you are introduced, they will actually look at it. General Atlantic Partners, probably on the bigger side, but I'm happy to share that with you afterwards. There are a lot of, I don't know I mean, think about your discussions on the phone when you talk to an investor first time. Confidentiality and NDA. This is what I hear about 80% of the discussions. My personal advice, screw it. NDA with an investor, why? It doesn't really make sense. And at the end of the day, the community is so small, they will talk to each other, very confidentiality, sometimes because of syndicating, joint investing, anything. You're not really doing anything. And the other point also is, a lot of investors sometimes ask you the question, listen, who else are you talking to? Share that. Why doing a secret about it? Who are you talking to? They will not run to them and say, like, listen, we want to do this, or we'll outprice them. Just give them the information. It's competition, and they know this. The market is sound and mature enough. On the operation side, big mistake is that people still believe, and that's probably more a German thing, that technology goes before marketing and sales. I've seen a lot of incredibly great technologies going bust because of missing sales and marketing. And again, and that's something where I have to contradict Barend, that I still believe that a sound, professional, unique marketing and services and sales organization can by far market a shitty product much better than vice versa. And they will be more successful. We've seen it with Microsoft. DOS was not a really sophisticated product. It was Macintosh at that time. But they had the better distribution. In terms of, yeah, that's a good one too. I hear a lot that when it basically goes like this. Listen, dear founder, So you don't have a CFO. It's like, no, we don't have a CFO. And then they say, listen, for us, more the coding, more selling the product, and whatever they do is our core business. Fundraising is not, and capital raising is really not our business. That's not our core business. You shouldn't do that. That's nonsense. You know, you have the asset side of your business, and you have your equity and liability side. That's pretty much an integral part of your future corporate life. If you don't manage it professionally and basically admit it in the first line, it's not amount of trust which you will build. And that applies to the line also, which we heard very often. Structures are built at a later stage. Now at the moment we are more the creative massive group of people and do the business. It may work in some industries, so I don't want to cross this out as complete bollocks. However, think about this. Investors do like to invest in scalable business. They do like to invest into teams which can execute. And that basically requires structures, organization. So if you think you want to stress creativity, do it in a sound and smarter way than I have just formulated. And here, these are the highlights, I would say, the 5 best of for financials. Number 1 is our calculation of working capital is very conservative. That's absolutely bullshit. I've never seen a conservative working capital ever in any business plan. Secondly, nobody really wants to talk, or you miss the information where the funds are actually used for. And that's a bit driven sometimes by the entrepreneur. I just don't want to be controlled for every money I'm spending afterwards. I'd like to keep that a little bit foggy in different buckets, but I would like to do this afterwards on my own. It's certainly not something investors like, particularly not in the early stage, because they would like to close up they link with you mentally very closely to see where you would like to spend the money, where do you see the maximum return by spending it. Have you ever seen it's a lie chart where you have 10 competitors on one side, you have 7 criteria, and then you see the dots, the full dots and the empty dots, and your business has all the full dots and the others one have all the empty dots? It's a lie chart. You see that in any presentation, and trust me, don't put it in anymore. Leave it out. Talk about competitors in a quantitative way. Value their strength, but don't tell them that you are better than Microsoft. It won't work. It just really, you lose credibility on those charts. It's a waste of time. Profitability in 24 months, it's also where we see always at the end, we are very convinced that we're profitable in 24 months. Be aware of what you're actually saying there. And this is something which I see more in Turkey than in Europe at the moment. We'll be going public in 3 to 5 years. That's a typical one. Where's the exit fantasy? It's IPO. And it's only IPO, by the way, in Turkey. It seems to be that the market here is assuming a lot of capital, which, by the way, it isn't, because last year was 750 million on around 30 IPOs. So there is not that much capital going via IPO. It's a tenfold on trade sales. It's a tenfold on combinations, and it's a tenfold on bankruptcies also. It's a big exit channel too. I don't know whether you've seen that one too. The last one, enclose. I've seen a lot of founders who have enclosed their valuation, their peers, the companies they would like to compare themselves to, and also their multiples, so the investor who actually that's his business could actually read how much the company is valued. That's something, it's a bit obnoxious, I would say, and patronizing. You shouldn't do that. Trust me, the investors will have a good view on valuation. You can discuss that. You can be prepared. Don't put it in there. Having said this, I don't want to be frustrating now. Actually, you shouldn't listen to those speeches like me at all, because they're very personal. That's how I made my experience over the last 20 years. However, I can give you one very important personal advice, who I actually think that's actually worth paying and coming to this conference. And this advice comes as this. Basically, be yourself. It doesn't make sense to show up and create a vision of yourself which you would like to see yourself. Just be yourself. It will come out anyway over the time of an investment. So don't bother. Just your strength is how you are, and that's actually how you should be. And that's a very important advice. Secondly, treat a fundraising event a bit like that you're getting married, with all the consequences, with all the love and passion and affection for this. And trust me, then you will make much better decisions. There will be more sound in your life, and the investors will be more appreciative. Thirdly, think straight and talk straight. I've been always asked by investors, should I, the valuation might be at 50 million euro. Objectively, should I start with 70 and then we end up at 55? It's better than only by 55 and they cut me down to 40. Again, talk straight, think straight. It will help you by far much more. People will appreciate that around you. And last but not least, there will be a lot of no's. There will be a lot of disappointments, in particular also by the evolving time over your business plan. There will be disruption. There will be stress with your investors. And that's something 100% sure. So I think the best advice is you should never give up. And that's something I would like to end this with. It has been a pleasure talking to you, particularly as the last speaker. I'm seeing people leaving. May I announce that the bar is open now, or will you come and have some more words? No. Thank you very much.
Thank you, Stefan. It was great.